if we are not looking to grow our token spend multiplicatively over the next few years, it is very hard for us to then underwrite and generate alpha on a standalone basis in some of these investable opportunities, because you see this so often within the public narrative of people trying to have well-informed views of how AI is shaping enterprises and adoption, when the vast majority of the workforce or organizations are not using the latest generation of Claude code or Codex or tool use or agentic workflows.
Hi, everyone. Thank you for being here. And I'm excited to moderate this panel. We're looking at the return of liquid alpha. This is a fascinating time to be talking about hedge funds, to be looking at the environment that we're trading in these days. So we'll jump right in. We have John Calcaterra. He's Senior Portfolio Analyst at Albourne. We have Shane Sandoval, Managing Director of Public Equities and the Head of Technology over at Atreides Management. Beside him, we have Weitman, Managing Partner and CIO at CastleKnight Management. And last but not least, Pieter Fyfer, Portfolio Manager at Arini. Thank you, gentlemen. So let's start with what the environment is like right now for trading your respective strategies. We're seeing valuations in equity markets being incredibly high. We're seeing private market valuations impressive. We're seeing volatility, as we saw in the market just the other day. Pieter, why don't we start with you? Looking at the credit environment, where do you see the biggest opportunity, and how do you navigate this environment?
Yes, thank you very much, Hema. For us, Alpha, we are long-short credit fund manager. We focused significantly on Europe, but increasingly in the US as well. Credit has been a very attractive area for us in recent years in terms of alpha generation, particularly in Europe, where I think it's in the developed market, there's a lot more inefficiencies in terms of where credit is priced. I think the complexity of the different insolvency regimes in each country helps. So if you have depth in your research team, which is something we've invested a lot, there's predictable alpha that can be captured. I would say the performance have been largely driven on the long convexity side of our book. I think increasingly the opposite will be true from here. Just given how compressed the credit market is trading, I think negative convexity focused trades will become a lot more important. And we're certainly tilting a lot of our focus on that negative convexity side. AI is a huge theme, of course, in the equity market. In the credit market, it hasn't been a big alpha generator. There's a big supply theme on that, and the Hyperscaler issuing a lot of bonds, and it's changing the corporate bond market to some extent, just given the sheer scale. But we haven't really seen the businesses that getting disintermediating selling off in credit. And on the same end, you don't gain from the winners as you do. It's sure some of our my fellow panelists will discuss. But I think that will be a focus going forward. So we spend a lot of time in terms of a forward-looking alpha capturing to identify the winners from the losers, particularly the losers in an asymmetric asset class. So as we shift our focus to more short convexity, the disintermediated AI plays becomes a key focus.
Interesting. And looking at your event-driven portfolio, how do you distinguish between alpha and beta in this type of a market?
All right. First off, again, we're finding a whole wealth of interesting event-driven opportunities across equity and credit. Again, we tend to be a little more higher returning fund, 30% net CAGR. I would say, again, part of it, we're finding things in AI. We're finding things, we like to really have names, whether it's equity, whether it's credit, names with catalysts and events that are going to drive returns. That may insulate the portfolio to some degree in more volatile markets. We are oftentimes trying to find those doubles or more. I would say we are finding AI side. We're still finding stuff that are, names and businesses that are inflecting dramatically higher. And we like to find those doubles. Credit side, we are still finding businesses that in some instances have been thrown out. where people have missed the AI upside. And time again, we found some of these businesses, even where the debt's trading as low as in the 20s. We're finding it even this year. AI-related debt in the 20s, where people were missing the inflection, missing the catalyst, and we're happy to take advantage of that. I'd note the debt's now, some of that's in the 80s now. But methodical, disciplined process to take advantage and find these kind of underappreciated opportunities. And it remains a pretty exciting market for us.
So you are still seeing underappreciated opportunities. Shane, how are you trying to find those in this equity market, given the volatility we're seeing specifically in AI and narratives around crowdedness in the space?
Yeah, thank you. So first and foremost, our approach to generating alpha in AI really starts with domain expertise. I think if you look at the market writ large, there's tens of trillions of dollars which are moving in fast fashion in and around highly complex, algorithmic or hardware changes. And we're fortunate enough as an organization, having been invested within data center hardware and infrastructure since inception, and our founder, Gavin Baker, who many of you may know, has been doing this for the better part of 25 years. So this compounding knowledge and advantage is important at this nexus of AI, and at the heart of this is crossover. I think in order to underwrite Nvidia, Avago, any one of the large cap hyperscalers, it's essential to be looking at what is happening at the frontier of emerging technologies on the startup side. So crossover is one important approach in order to do that. The second, though, and just to push back a little bit, there's a lot of talk about AI mania and bubbles, but at the end of the day, if you look at kind of where the Nasdaq is trading today on a forward earnings basis, it's anywhere between in line to marginally below the 10-year average. So within AI, there are undoubtedly pockets of kind of asynchronous hype and those which are detached from fundamentals, but it's incumbent upon us to find the opportunities that may screen as expensive at 20, 30, 40 times earnings, but in terms of the true underlying earnings power of these businesses, maybe 50 or 60% lower. So we're trying to isolate this exponential demand curve that we're on in AI, and really find the enabling technologies which are going to allow that exponential curve to either continue or even accelerate further. And I think that's just going to open up a much broader set of opportunities to generate alpha in the public markets, to a wider swath of equities. And the greatest example of this is, if you look at the Vera Rubin rack, which is Nvidia's latest and greatest GPU, there's 1.5 million components, and there's over 200 suppliers. So the opportunities to generate alpha within that, opportunity set continues to expand by the day.
John, as our allocator voice here, when you look at allocating to funds in this environment, when you see some funds kind of riding the beta wave of AI, other funds being more cautious, maybe missing out on some of those gains, expecting some caution around the corner, how do you figure out where to invest? What are the risks that you weigh and that allocators might think about when it comes to either missing an opportunity or getting caught with too much exposure across too many managers?
Yeah, I think it's important to understand that volatility can cut both ways, to the left tail as well as the right tail. But in general, in speaking with allocators, we've had a lot of interest around dedicated AI offerings on both the public and private side of their portfolios. In particular, we've actually, I know this is a hedge fund panel, but we've had a lot of conversations around the private side and exposure in AI with a lot of allocators, particularly those who don't have exposure to these high-flying private AI-related names. They're having conversations with their boards where they are looking at peer performance and getting pressure in terms of that underperformance and getting the questions of why don't you have exposure to this? We've had a lot of conversations around kind of AI in privates. On the hedge fund side of things, seen a lot of interest in dedicated AI-related offerings. We're believers that this is going to be a tailwind for the hedge fund industry in general. There's going to be winners and losers, not just within tech and software, but based on AI adoption, cross-sector, cross-industry, there's going to be a lot of good opportunities, not just on the long side of the book, but on the short side as well.
Mm-hmm. Are there certain strategies that are falling a little bit out of favor while others fall into?
I think not AI related, but I think just in in terms of general hedge fund interest, we've seen a bifurcation of interest from allocators. On one side, it's really kind of the the strategies that have the ability to add alpha to equity portfolio. And on the other side, it's more diversifying strategies. So on the equity alpha piece, that manifests itself through active extension, portable alpha type mandates, just definitionally active extension, 100% net long, equity long short fund. The gross exposure varies. And then in portable alpha offerings, think of this as market neutral alpha that's ported on top of a beta 1 exposure via leverage. And really that's gotten a lot of interest from allocators as a result of the adoption of the total portfolio approach. So the idea that you don't have traditional asset classes, you have risk factor buckets, and is somewhat structure agnostic. So you can put a hedge fund within your equity bucket if it's 100% net long. That has gotten a lot of interest from allocators. Also, on the active extension side of things, there's a reduction in tracking error against an equity benchmark, right? So allocators have faced a lot of pressure post-GFC in looking at their equity hedge fund portfolios, given the absolute underperformance versus equity benchmarks. And that's been a real career risk. So the solution to fix this is they can allocate to these funds that they've underwritten, they understand the fundamental value prop, but there's going to be less tracking error around that as well, too.
We've touched on how you think about investing around AI, but gentlemen who run the funds, I'm curious, how are you using AI as a firm to help you generate alpha? And maybe you can each talk about spend on tokens, spend on AI infrastructure, how as a firm you are optimizing the technology yourselves. Shane, do you want to start?
Yeah, look, I think if you look back over the last few years, it was very much on one end of the spectrum, some of the largest quants who were able to generate alpha using alternative data and signals, that we as bottoms-up fundamental stock pickers were, just not capable or well adapted to really monetize. I think the world as a bottoms-up fundamental manager is changing, where it is entering this world of man with machine. And it's incumbent upon us to, adopt AI throughout our entire research process, throughout our entire organization. One, so that we can increase the productivity and efficiency of every person within the organization, so that at the end of the day, we're spending dollars against one specific target, right? Which is to increase either our batting or slugging percentage as a fundamental manager. And I think the second, which is as a technology-focused firm, if we are not looking to grow our token spend multiplicatively over the next few years, it is very hard for us to then underwrite and generate alpha on a standalone basis in some of these investable opportunities, because you see this so often within the public narrative of people trying to have well-informed views of how AI is shaping enterprises and adoption, when the vast majority of the workforce or organizations are not using the latest generation of Claude code or Codex or tool use or agentic workflows. So we're trying to push the ball forward as much as possible to drive superior risk-adjusted returns where possible.
When you mentioned the token growth, can you give us some sense of what that might look like, dollars spent or degree of growth percentage?
Yeah, I would say the mandate from the top is for that to grow multiplicatively from where it is today. Okay. The starting point was obviously much lower, right. But if to put into perspective, as a single manager, you may have a budget, whatever it may be for alternative data and for people and for engineers, token spend will be a multiple of that. In the future, and that will permeate every seat within the organization, not just the investment team, finance, accounting, operations, go down the list.
Aaron, can you talk a little bit about use cases?
I would say, again, we continue to look for where can it be, additive to our research process, providing us additional data, making the different employees within the firm more productive, looking at legal cases, looking at enhancing our macro views and just finding and continuing to analyze that different data sets. We continue to trial and look at many different newer products, and I think we'll continue to be adding them to our research process and certainly within the firm. I've heard some people complain it ends up, as much as it is productive, they end up adding how much time they're spending around the different AI products. Yeah. And I think that can be a balancing act, but we certainly think it can be additive, as much as we're finding it and think it'll be additive to the investment opportunity set and your average business looking forward.
Peter, are there ways to optimize when we think about hiring talent, or are you thinking about how to replace, in some cases, humans with the agents? How are you weighing the opportunity with, let's say, hiring and expanding, or ways that you're thinking about the use of analysts?
Yes. I think first of all, we want to share best practices as much as possible. You know, AI, of course, there's different levels of engagement and adoption within most firms. And I think in the first principle, you want to make sure that you share that across the firm. I think at certain segments of our business, clearly it reduces the hiring demand. But I think the interpretation side is still very important, where I think the experience level is not yet at a level where that is replaceable. It's just getting the data analyzed in a format where better decisions can be made, the speed of analyzing data, but no direct impact on our hiring plans for now. But for sure, we've seen the headlines from the banks and the graduate programs, etc. But for now, I mean, we're a growing firm. If anything, we significantly net hiring rather than anything else at this point of the cycle.
Mm-hmm. John, so go ahead. John, can you talk a little bit about how we think about fees in this environment as an allocator? Where is the ball shifting? And who has the negotiating power? I know it depends in some cases on the type of firm and the size of the firm, but are you seeing a shift in trend in where fees are going and how, and I guess especially given some of the gains that we're seeing in funds that have private exposure and the desirability to access those funds and get that opportunity, is that impacting the fee structure?
Yeah, you kind of hit it on a little bit of the answer with your question there. It is very strategy specific. At Albourne, we've always been proponents around alignment of interest for LPs in terms of fee arrangements. We've done research on risk-free rate hurdles, D-beta-ized fees, 1 in 30. This is kind of in our DNA. I will say recently we've done a lot of work around the risk-free rate hurdle. Starting in 22, we did a lot of research around which hedge fund strategies perform best under higher interest rate environments. The takeaway was kind of across strategies, we've seen better performance from hedge funds in the higher interest rate regimes. And you can think of certain factors why that's the case. The unencumbered cash balances, short rebate, higher vol that's usually associated with higher rate environments typically is a good environment for hedge funds. And so what we did from there was kind of decompose the different risk factors leading to the higher performance, found that the risk-free rate had the highest explanatory power. We essentially took those findings out to our clients and organized an open letter to the hedge fund industry calling for risk-free rate hurdles. We don't think LPs should be paying fees on cash. And so we've had mixed adoption as a result of that research. I would say it's very strategy specific. A strategy like CTAs, where there's a very high level of unencumbered cash balance, is more willing, I think, to negotiate on the risk-free rate side of things. Other areas where access is very constrained, call it the platform side of things, there's less willingness to negotiate in terms of those risk-free rate hurdles.
Mm-hmm. Do you think differently about the risk that's involved with backing new startup multi-strat funds?
Yeah, I think, given kind of recent headlines and some of the deferred comp agreements that got pulled forward as a result of those funds shutting, there's going to be a lot of LP discourse around docs going forward if they do back a startup platform fund to make sure that they're not kind of pulling forward these deferred comp agreements all in 1 month if there is the shutdown risk for a specific platform. So that's something that's been top of mind for a lot of LPs as well, too.
And you think the documents are going to be changing, the due diligence process?
We're at the early stages of that, just given kind of how recent some of these headlines have occurred. But we are having active conversations with other industry groups and our clients as well.
Mm-hmm. Shane, what are you most worried about right now?
What am I most worried about? Look, I think the most important thing for us looking at AI is less about macro and what happens with geopolitical instability, but I really think it comes back to what are the true underpinnings which are driving, the exponential demand curve that we're seeing today. And I think for us, the most important touch point that we look to, as an AI-focused, investment firm is really where is the ROI on the latest generation of Blackwell models in other, leading edge silicon out of the large providers. And why is that? Because historically, all of these AI returns have really been driven by the hundreds of billions of dollars of CapEx that have been put into the system through the hyperscalers in sovereign AI. And this is all predicated on, the scaling laws, whether that's pre-training or post-training in RL and inference in AI persisting. And what this all basically means is that for as long as these large entities are able to continue to put hundreds of billions of dollars to work, where the intelligence of the number of tokens and the total economic value coming out the backside of them continues to grow multiplicatively in the future, has downstream impacts to the entire value chain. So I would say that's number one. And then number two, which is, the world of AI is moving so quickly, we continue to be very mindful of the opportunity for new algorithmic innovation or hardware innovation that could really change just the amount of CapEx and the amount of dollars which are flowing in. A lot of the ecosystem is really predicated on the success of LLMs and transformers today, but there are worlds where different algorithmic breakthroughs may change the landscape in terms of the necessary dollars of invested capital, which has an impact on the entire AI value chain.
Mm-hmm. Aaron, I'm curious what you are watching and are concerned about. One thing that we're thinking about is SPVs and the use of SPVs in some of these private investments. I don't know if you sort of have looked at that space at all and if you have thoughts. Otherwise, another concern that maybe is on your mind.
I would say I'd mostly pass on that. We have done a co-invest at one time. Certainly, I'm watching what's occurring in those markets.
Yep.
But that's more away from my single fund that I'm focused on.
Is there anything else that
I guess I could go back to the risks of the market.
Yes.
I would say we are cautiously optimistic, the broad economy. We are always macro aware. We were early to talk about risks in front of the Ukraine escalation, talking about potential escalation in front of the Iran situation. I think we also want to then, I think the longer term impacts of the Iran situation and how it settles, I think is going to be with us for longer than a year. I think it's going to continue to have broad-based impacts and some risk to the markets. We need to see what happens with inflation, what happens with interest rates. But balancing all that, we are cautiously optimistic and still finding a lot to do.
Do you feel a bit more risk off than you traditionally would be?
What'd you say?
Do you feel a bit more risk off than you traditionally would be, or are you opportunistic at this time?
I would say at the moment we're fairly invested and pretty excited. I think we need to continue to monitor, risks of further escalation around the Iran situation. Do we have chance of a settlement in the next month or so, or is it going to potentially continue to be on and off issues and even escalate to a much greater degree through year end? Do we still have a chance of $150 oil? We need to continue to monitor and look at these different risks, and certainly we will make adjustments to the portfolio accordingly. But netting my current view on all of that, I remain pretty excited.
Mm-hmm. Peter, how resilient do you see liquid credit right now versus other liquid alternatives in this kind of a risk-off environment?
The credit market trades very tight, very compressed. I think is mainly downside risk as an asset class. With regard to a long short, it's a great opportunity. Purely the relative cost of shorting is very low. Whether you look at it quality to non-quality, long duration to short duration, junior debt to senior debt, it trades extremely compressed. So we're very focusing on adding that negative convexity here. Do we see a reason for an imminent significant sell-off in the credit market? Not short term, but we are seeing some weakness. We are concerned with regard to the maturity load that the refinancing need. we are certainly in an environment of higher rates for longer. In Europe, you have operational cost aspects. Will it be, globally commodity driven, but also minimum wages, UK, Germany, Spain. So there's pressure. So we're going to see a pickup, in our opinion, of defaults. And yeah, there are still long opportunities in that restructuring episodes, but generally, I think from here, the opportunity is on the widening side. Certain segments of the financial sector concerns us. Post-financial crisis, the banks are very well capitalized, very well regulated, very conservative. But you had a emerging shadow banking sector in the financing side, which I think is taking a lot more risk. And I don't think you want to paint these industries with the same brush, but several segments are taking considerable more risk than pre-financial crisis. Will it be, private sector BDCs, some of the insurance segment is certainly taking a lot more risk than pre-crisis. So I think that will present opportunities. In terms of the one risk factor I think a lot of people don't talk about is just the government side, risk-free. Fiscal balance sheets are not in a good position. We are running high deficits. Does the risk-free become the source of a risk-off environment? And how does the relative asset classes behave in that context? I don't think there's a trivial risk at this point in time with regard to that aspect.
And you launched a new fund recently at Arini. How are you seeing investor appetite for the multi-strat product?
Yeah, Hema, that's, we launched a beta neutral, market neutral, diversified alpha fund where we're exclusively focusing on capturing alpha within the various segments of the credit market. So the idea is to allocate capital into where we see the most predictable alpha is in the credit environment and not taking long-only risk, but really focusing on, as the name suggests, diversified alpha. So we think it's particularly in the current environment where the case for long credit is in our opinion, pretty poor. The shift to a very diversified fund, low concentration risk, lower vol profile, we think is what a lot of our investor partners would like to see. We give access to a wider range of our ideas to our investors compared to our concentrated hedge fund, our master fund, which we close to new investors. So it's, I think, a very interesting product for the credit market. I don't believe there's a lot of those products out there. I managed PM some of the strategies within that. And certainly well-positioned, I think, for the current compressed environment.
And John, we'll give you the last word here. As you look through the variety of hedge funds that are often pitching to you, as you try to make allocations and suggestions to your clients, is there anything that you'd like to see more of from the hedge fund selection? Any advice you might have for hedge fund managers as they seek to asset raise in this environment?
I'd just say alignment of interest around fees, around duration of capital. If the underlying is fairly liquid, there's really no reason for 5-year lock for just liquidity terms. So I think alignment of interest with the LP, I think, is a number of conversations we're having around that.
Mm-hmm. How do you think about the talent war in conjunction with pass-through costs and those really being pushed on to the LP?
Yeah, allocating to a platform is kind of a different beast. They are talent aggregators, so if the price for talent goes up, that's kind of what you're signing up for when you're allocating to a platform. So while those costs on a headline number look fairly eye-popping, we're focused on the net return that managers can offer, not necessarily the gross.
Well then, gentlemen, thank you so much.
Thank you.
Keep talking.
Thank you.
But we are out of time. But thank you to John, Shane, Aaron, and Pieter.